Insurance is one of those things almost everybody has heard of, but very few people actually understand. You pay money every month or every year to some company, and in return, you're promised protection against some kind of risk. But how does that promise work? Why do insurance companies agree to take on your risk? And why has insurance become such a powerful industry that quietly shapes the way modern society works? Before we get into the details of how insurance operates today, we need to understand where it all started. So, what exactly is insurance? At its simplest, insurance is a system where a group of people pool their money together to protect themselves against losses. If one person in the group suffers a big loss, the pool of money is used to cover it, so no single individual is ruined. It's about spreading risk, sharing uncertainty, and creating stability in a world where accidents, disasters, and unexpected events are inevitable. But this idea didn't appear in modern times. It's thousands of years old, and history shows us that humans have always tried to find ways to guard themselves against the unknown. The earliest forms of insurance go all the way back to ancient Mesopotamia. Traders traveling across dangerous trade routes knew that bandits, storms, and accidents could destroy their goods at any moment. So they created agreements where a group of merchants would contribute money into a fund. If one of them lost their cargo, the fund would compensate them. This way, no single trader would be wiped out by bad luck. These agreements were so important that they were even written into the famous Code of Hammurabi around 1750 BCE, one of the oldest sets of laws we know of. In it, you can find rules about loans, shipping contracts, and protections against loss. In other words, early forms of insurance. As civilizations advanced, the idea of sharing risk spread across the world. In ancient China, merchants sailing along rivers would divide their goods across several boats. If one boat sank, no one merchant would lose everything. The loss would be shared, and the risk was reduced. In Babylon and Egypt, temples and palaces played the role of financial centers, sometimes even offering loans and storage for valuables that could be replaced if stolen. But perhaps the most famous early form of insurance developed in the Roman Empire. Roman soldiers, merchants, and guild members would contribute to what was known as burial clubs. These were organizations that collected money from their members to pay for funeral costs if someone died, or to support families left behind. It might sound simple, but this was insurance in its rawest form. Regular contributions to protect against a guaranteed future event, death. The Middle Ages brought another important chapter in the history of insurance: maritime trade. As Europe expanded its trade across seas, the risk of losing ships and cargo became massive. To protect merchants, maritime insurance contracts began to appear, especially in Italy's powerful trading cities like Genoa and Venice. These contracts were written agreements where insurers promised to cover losses if a ship sank or cargo was stolen by pirates. In exchange, the merchant paid a fee, the earliest version of today's insurance premium. By the 17th century, insurance had taken on a more formal shape. In London, coffee houses were not just places to drink coffee, they were centers of business. Merchants, ship owners, and investors gathered at Lloyd's Coffee House to negotiate contracts, exchange news, and cover risks. From these gatherings emerged what we now know as Lloyd's of London, one of the most famous names in global insurance. Lloyd's became the place where wealthy investors agreed to underwrite risky ventures in exchange for premiums. If a ship made it back safely, the investors profited. If disaster struck, the underwriters paid out claims. This same period also gave rise to another form of insurance: fire protection. The Great Fire of London in 1666 destroyed over 13,000 houses, leaving tens of thousands of people homeless. The catastrophe highlighted the need for organized protection against property damage. Soon after, the first fire insurance companies were founded. They even employed private fire brigades who would only put out fires in houses that had the company's insurance plaque on the wall. If you didn't have insurance, they simply let your house burn. Over time, these systems became more organized, regulated, and widespread. By the 18th and 19th centuries, as the Industrial Revolution transformed societies, insurance expanded beyond ships and fires to cover life, health, and business risks. People working in dangerous factories, families dependent on one breadwinner, and businesses investing large amounts of capital all needed ways to protect themselves against ruin. Insurance became an answer to the growing complexity of life. And that brings us to the modern age. Today, insurance is one of the most powerful financial industries in the world. It influences how we drive, how we work, how we build houses, and even how long we live. But before we get ahead of ourselves, let's step back and break it down. How does insurance actually work in practice, and why is it so central to our lives? So, now that you understand where insurance came from, let's get into how it actually works today. At its core, the idea hasn't changed since ancient times. A group of people pooling money together to protect each other. But the way it's structured and managed has become far more sophisticated.
When you buy an insurance policy, what you're really purchasing is a promise. You pay a regular amount of money, called a premium, to an insurance company. In return, the company promises that if a specific event happens, like your car being damaged, your house catching fire, or you needing medical treatment, they will cover the costs, either in full or in part. The premium is essentially your ticket into the risk pool, and the size of that premium depends on how risky you are considered to be. Think about car insurance. If you're a 45-year-old driver with a clean record, your premium will probably be much lower than an 18-year-old who just got their license. Why? Because statistically, young drivers are far more likely to crash their cars. Insurance companies don't know if you personally will have an accident, but they know from massive amounts of data what the odds are for someone like you. That's what they're pricing into your premium. This is where the science of underwriting comes in. Underwriting is the process insurance companies use to evaluate how risky it is to insure you. They look at your age, your health, your job, your habits, your history, and sometimes even where you live. All of these factors help them decide how much to charge you. If you're low risk, your premium is lower. If you're high risk, your premium is higher. And in some cases, if you're too risky, the insurer may refuse to cover you at all. But what happens with all the money you and millions of others pay in premiums? That money goes into a giant collective fund, the risk pool. Most people in the pool won't make a claim in a given year. For example, if 10,000 people each pay $500 in car insurance, that's $5 million collected. Maybe only a few hundred people will actually file claims for accidents. The cost of those claims might total $1 million or $2 million. The rest is used to cover the company's expenses, profits, and investments. That's how insurance companies make money. They rely on the law of large numbers, meaning that while individual outcomes are unpredictable, the overall pattern across thousands or millions of people is highly predictable. Now, the real heart of insurance is the claim process. A claim is when you say, "The thing I was insured against happened, now pay up." Let's say your house burns down. You contact your insurance company, file a claim, and they send an adjuster to verify the damage. If it's covered under your policy, they pay you a settlement so you can rebuild your house. The exact payout depends on the terms of your policy, the limits of coverage, and sometimes deductibles, which are amounts you pay out of pocket before the insurer covers the rest. Of course, insurance companies don't just hand out money without checking. They're constantly balancing between paying legitimate claims and avoiding fraud. Insurance fraud is a massive problem. People faking car accidents, setting fires intentionally, or exaggerating medical bills just to get a payout. That's why insurers employ investigators, auditors, and even artificial intelligence systems to detect suspicious claims. Another key thing to understand is that insurance companies are not just sitting on piles of cash waiting for accidents to happen. They actively invest the premiums they correct. Since most people don't file claims right away, insurers can take that money and invest it in bonds, stocks, or real estate, generating returns. This is one reason why insurance is so profitable. They're not only collecting premiums, but also using that money to grow even larger. Some of the biggest financial institutions in the world are insurance companies, with trillions of dollars under management. Now, you might be wondering, what happens if something catastrophic happens and too many people file claims at once? Imagine a hurricane destroying thousands of houses in one region, or a pandemic leading to millions of health insurance claims. Wouldn't that bankrupt an insurance company? Well, that's where reinsurance comes into play. Reinsurance is basically insurance for insurance companies. Big insurers transfer part of their risk to even bigger global firms that specialize in covering catastrophic events. This way, no single disaster can wipe them out completely. All of this shows that insurance is a delicate balancing act. It's about predicting risk, pricing it correctly, managing claims, and making sure the system stays solvent even when bad things happen. For customers, it looks simple. You pay a premium, and if disaster strikes, you get help. But behind the scenes, it's an incredibly complex machine built on statistics, finance, and psychology. Because here's the truth. Insurance is not just about numbers, it's about trust. You're paying money today for something that might not happen until years later, or might never happen at all. You have to believe that the insurance company will still be there, still solvent, and still willing to honor its promise when you need it. That's why insurance is so heavily regulated by governments. Without regulation, companies could take premiums, refuse to pay claims, or collapse under mismanagement, leaving millions of people unprotected. And that's the essence of how insurance works: pooling risks, charging premiums, paying claims, and investing the difference. But to really understand insurance, we need to look at the different types of insurance that exist, because not all policies are created equal. Life insurance, health insurance, car insurance, property insurance, each works slightly differently, serving different needs, but all follow the same underlying principle of shared risk.
Now that we've broken down how insurance works in general, let's take a closer look at the different types of insurance people use in their daily lives. While the core principle of pooling risk is always the same, the way each type of insurance is structured and the role it plays is quite different. Let's start with life insurance, because in many ways it's the most profound. Life insurance is not really for you, it's for the people you leave behind. Imagine a father of 3 who unexpectedly passes away. Without life insurance, his family could be left struggling to pay the mortgage, cover school fees, or even buy groceries. But if he had a life insurance policy, the insurer pays his family a lump sum or monthly benefits, providing financial stability during an incredibly difficult time. There are 2 main forms: term life, which covers you for a set period like 20 or 30 years, and whole life, which covers you for your entire lifetime and sometimes even builds up a cash value you can borrow against. Life insurance is essentially a way to turn an uncertain future into a guarantee that your loved ones won't be left in financial chaos. Then there's health insurance, which in today's world is almost unavoidable. The cost of healthcare is so high that one serious illness or accident could bankrupt a family. Health insurance spreads that risk across millions of people. You pay monthly premiums, and in exchange, your insurer helps cover doctor visits, hospital stays, surgeries, and medications. In some countries, like the UK or Canada, healthcare is publicly funded. But in many others, like the US, private health insurance dominates. One of the big challenges with health insurance is balancing affordability with access. If premiums are too high, people can't afford coverage. If premiums are too low, insurers may collapse under the weight of claims. That's why health insurance is often a political hot topic, because it affects everyone's life directly. Property insurance is another major category. Think about your house. For most people, their home is their single largest investment. A fire,
A burglary or a natural disaster could wipe it out in an instant. Property insurance exists to make sure that if disaster strikes, you don't lose everything. Homeowners insurance typically covers not only the building itself, but also the contents inside, like furniture, electronics, and clothing. Some policies even cover you if someone gets injured on your property and sues you. Renters can also buy insurance to protect their belongings, even if they don't own the building. Property insurance is one of the most common forms of coverage, and for good reason. Without it, a single accident could set you back decades financially. Closely related is car insurance, which is not just common, but legally required in most countries. Cars are both expensive and dangerous. One accident could result in huge repair bills, medical costs, or even lawsuits. Car insurance typically covers damage to your vehicle, damage you cause to other people's property, and medical costs for injuries. In some cases, it also covers theft or vandalism. What makes car insurance particularly interesting is how personal data is increasingly used to set premiums. Some companies now use devices that track your driving habits, speed, braking, mileage, and adjust your premium accordingly. Drive safely, pay less. Drive recklessly, pay more. It's a modern twist on the old idea of risk pooling, personalized by technology. Finally, we have business insurance, which is crucial for businesses of all sizes. Imagine running a small bakery. If a fire breaks out and destroys your kitchen, business insurance helps you rebuild and reopen. Or think about a global corporation facing lawsuits from defective products. Liability insurance covers those legal costs. Businesses often need multiple types of coverage: property insurance for their buildings, liability insurance for customer injuries, workers' compensation insurance for employees who get hurt on the job, and even specialized insurance depending on the industry. Without it, one accident or lawsuit could bankrupt a business overnight. There are, of course, many other niche forms of insurance. Travel insurance that covers canceled flights and lost luggage, pet insurance that pays vet bills, crop insurance for farmers, even event insurance for weddings and concerts. If there's a risk, chances are someone has created an insurance policy to cover it. Some sound strange at first, but for the people who need them, they provide peace of mind and financial protection. What all of these types of insurance have in common is this: they act as safety nets. They don't prevent bad things from happening, but they soften the financial blow when they do. Each type is tailored to a specific risk: death, illness, fire, accidents, lawsuits, but the mechanism is the same. People pool their money together, and when misfortune strikes, the pool is there to catch them. Insurance in this way is not just about money. It's about stability, security, and the freedom to live your life without being paralyzed by fear of the unknown. A person with health insurance is more likely to go to the doctor. A business with liability insurance is more willing to take risks and innovate. A family with life insurance can sleep a little easier knowing their children are protected. Now, understanding these types of insurance is important, but to really grasp why insurance matters, we also have to look at its bigger role in society. Because insurance isn't just something individuals and businesses buy, it's something that shapes economies, enables growth, and even influences politics. When we step back and look at the big picture, insurance is more than just contracts and claims. It's one of the hidden foundations of modern society. Without it, our world would look completely different. Think about infrastructure. Would banks finance the construction of skyscrapers, bridges, or power plants if those projects weren't insured? Probably not. Without insurance, the risk would be too great. A single accident could bankrupt investors and halt entire projects. But with insurance, risks become manageable, and huge projects that shape our cities and economies become possible. The same goes for innovation. Imagine if entrepreneurs had to personally shoulder all the risks of starting a business. Many would never try. But with business insurance, liability insurance, and other forms of protection, innovators can take chances knowing that one accident or lawsuit won't instantly destroy everything they've built. In that sense, insurance doesn't just protect, it enables progress. On a personal level, insurance gives ordinary people a sense of security that allows them to live fuller lives. Parents send kids to school knowing health insurance is there if they get sick. Drivers get behind the wheel knowing car insurance is there if an accident happens. Families sleep under their roofs knowing homeowners insurance is there if disaster strikes. We often take it for granted, but without it, everyday life would be filled with far more anxiety and hesitation. Of course, insurance isn't perfect. Premiums can be expensive. Claims can be denied. Entire populations can be excluded or underserved. In many parts of the world, access to affordable insurance is still limited, leaving millions of people one accident or illness away from financial ruin. That's why governments regulate the industry so heavily, because when insurance fails, society feels the impact. And as risks evolve, from cyber attacks to climate change, insurance will need to adapt. Think about climate change. Rising seas, stronger storms, massive wildfires. These are risks that insurers are already struggling to cover. In some places, property insurance has become unaffordable because the risks are simply too high. This creates a cycle. People need insurance more than ever, but insurers can't cover unlimited losses. The way the industry responds to these global challenges will shape not only its own survival, but also how humanity copes with an uncertain future. At the end of the day, insurance is about something bigger than money. It's about stability, security, and the freedom to live your life without being paralyzed by fear of the unknown. A person with health insurance is more likely to go to the doctor. A business with liability insurance is more willing to take risks and innovate. A family with life insurance can sleep a little easier knowing their children are protected. So the next time you pay your premium or sign a new policy, remember what you're really buying: peace of mind. You're buying the ability to face tomorrow with a little less fear. You're part of a centuries-old system that connects merchants on ancient trade routes with families in modern cities. Insurance is, in its simplest form, a promise. A promise that when the unexpected happens, you won't face it alone. And maybe that's the greatest value of all.